Well, the government has introduced significant changes to the income tax regime when it tabled the budget in July last year. So what do taxpayers need to keep in mind while filing their income tax returns later this year? Shivani joins us with a list of things to do. Shivani.
Well, absolutely. The tax season has begun and there are some key changes that tax filers should keep in mind for 2025. Let's break them down. First, the new income tax slabs under the revised new tax regime. The basic exemption limit has been raised from 2.5 lakh rupees to 3 lakh rupees now. This means income up to 3 lakh rupees is now tax-free. Tax rates have also been restructured. 3 to 7 lakh rupees is taxed at 5%, 7 to 10 lakh is taxed at 10%, 10 to 12 at 15%, 12 to 15 at 20%, and over 15 lakh rupees annually remains in the 30% bracket. These changes aim to provide relief for the lower and middle income groups. Next, significant update for capital gain taxes. Short-term capital gains on equities are now taxed at 20% up from the earlier 15%. Long-term capital gains have a flat tax rate of 12.5% compared to like the equities used to be taxed at 10% earlier, but the exemption limit has now increased from 1 lakh rupees to 1.25 lakh rupees annually. Plus, the holding period for long-term classification has also been simplified, 12 months for listed securities like equities and 24 months for other assets. For those contributing to the National Pension System, the NPS, there's good news. The deduction limit for employer contribution has increased from 10% to 14% of the basic salary, helping you save more for retirement. Salaried employees can also now claim TDS and TCS credits for taxes deducted or collected at source on other incomes and expenses. This ensures more accurate deductions on salaried income. And finally, for luxury shoppers, a higher TCS rate applies to purchases over 10 lakh rupees, making high-end items more expensive. These changes could impact how you file your returns, so make sure that you plan accordingly and stay informed this tax season. Back to you.
All right, Shivani, many thanks. Now,